You're scrolling through financial news, and every major bank just dropped their silver price predictions for 2026. Goldman Sachs says one thing, JP Morgan says something completely different. Citigroup's calling for $100 by March. Some algorithm-based model is projecting $900 by year end. And here's the part that should make you laugh. 9 out of 26 professional forecasts were already obliterated in the first 3 weeks of January. These are the smartest analysts at the biggest institutions in the world, armed with supercomputers and decades of data, and they couldn't predict 3 weeks into the future. So why should you believe anything they're saying about the next 12 months? The answer is, you shouldn't. But not for the reason you think. My name is Alex, and I've spent the last 8 years reverse engineering how institutional predictions actually work versus what they tell the public. And what I've discovered is that these forecasts reveal far more about the banks making them than they do about silver's actual trajectory. If you're trying to make sense of the precious metals market without getting played by institutional noise, make sure to hit that subscribe button and give this video a thumbs up. Because what I'm about to show you is how to decode what the smart money is actually doing while they're feeding you predictions they don't even believe themselves. Here's what's happening right now. The London Bullion Market Association just released their 2026 forecast survey, and it's the most bullish precious metals outlook in over 2 decades. Professional analysts are projecting silver's average price to double from 2025 levels. That sounds impressive until you realize that with silver already trading above $95, nearly a third of those forecasts are already worthless. Citigroup's commodities team is calling for $100 by March. That's just 5% from current prices. Long forecasts algorithmic models show silver trading in a range between $93 and $163 by year end. Alan Hibbard from Gold Silver expects silver to outperform its 147% gain from 2025, with a price target of $175 or higher. He's pointing to a multi-decade technical pattern that suggests $400 is mathematically possible. Meanwhile, algorithm-based models from CoinCodex show a 2026 range anywhere from $93 to over $900. Think about that spread for a second. The range between the lowest and highest professional prediction is almost 10 times. That's not forecasting. That's guessing with extra steps. But here's what nobody's telling you about these predictions. They're not designed to be accurate. They're designed to be defensible. There's a massive difference. When Citigroup projects $100 by March, they're not making a bold call. They're making the safest possible statement that still sounds like analysis. Silver's at 95. Calling for 100 in 2 months means they're betting on exactly 6% upside over 8 weeks. That's not a forecast. That's a hedge. If silver hits 100, they look smart. If it doesn't, they were only off by a few percentage points. If it goes to 150, they can say they were directionally correct but conservative. It's institutional CYA disguised as market insight. Now contrast that with Alan Hibbard's call for 175 or higher. He's actually pricing in structural factors that most banks conveniently ignore. 5 consecutive years of supply deficits. China's export restrictions that took effect January 1, 2025. The United States government designating silver a critical mineral for the first time in history. These aren't speculative factors. These are documented realities that have already happened. But here's the problem. If Hibbard's right, it means the conservative forecasts aren't just slightly wrong. It means they're catastrophically mispriced. And banks can't afford to be catastrophically wrong in their public predictions, even if their private trading desks are betting on exactly that outcome. Let me show you why this matters more than you think. We're about to get into the psychology of institutional forecasting, and once you understand how this game actually works, you'll never look at a bank prediction the same way again. The LBMA survey is considered the gold standard of precious metals forecasting. Every year, they poll professional analysts, traders, and strategists from the biggest institutions in the world. The 2026 survey included 26 participants. These are people whose entire careers depend on getting commodity prices right. And by January 23rd, 9 of those 26 forecasts had already been invalidated. Silver blew past their year-end targets before the month even finished. Think about what that means. 35% of professional forecasters were mathematically eliminated from accuracy in less than 4 weeks. If your weather app was wrong 35% of the time about tomorrow's forecast, you'd delete it. But we're supposed to trust these same institutions with predictions 12 months out? Here's where it gets interesting. The conservative forecasts in that survey, some as low as $42, were based on models that assumed silver would behave like it did from 2020 to 2024. Modest volatility, gradual appreciation, maybe a spike here and there, but nothing structural. Those models couldn't anticipate silver tripling from $30 to $95 in 12 months because their entire framework assumes mean reversion. They're designed to predict that markets return to historical averages. That works beautifully until it doesn't. And when a commodity enters a structural bull market driven by supply constraints and industrial demand that didn't exist in the previous dataset, those models don't just underperform. They become actively misleading. Ross Norman, one of the longest-running participants in the LBMA survey and a former banking and refining executive, has been forecasting precious metals for decades. He understands better than most that the models break down when the underlying conditions change. But here's the thing. Even if Norman personally believes silver could hit $200, he can't say that publicly without risking his credibility if he's off by 50%. So the published forecast becomes a negotiation between what the data suggests and what's professionally defensible. That gap between private conviction and public prediction is where the real information lives. Now let me show you the pattern that repeats throughout financial history, because this is the part that should make you deeply skeptical of every single one of these predictions. Silver doesn't move in predictable patterns. It sits dormant for years, trading in a narrow range while analysts get comfortable with their models. And then it explodes. 1980, silver spiked to $50 in an event that no model predicted. 2011, silver rallied to $48, catching nearly every major institution off guard. 2025, silver went from $30 to over $94 in 12 months, a 147% gain that made it the best performing asset of the year. Not a single major bank forecasted that move at the start of 2025. Not one. The Federal Reserve didn't see it coming. The World Bank didn't see it coming. Citigroup, JP Morgan, Goldman Sachs, every single bulge bracket institution with armies of PhD economists missed it entirely. So when you see an analyst projecting $400 silver based on technical patterns, you need to ask yourself, if the biggest financial institutions in the world with unlimited resources can't predict 3 weeks into the future, why should any long-term technical target mean anything? The honest answer is, it probably doesn't. But that doesn't mean the prediction is useless. It means you need to understand what the prediction is actually telling you. When Gregory Shearer, JP Morgan's head of base and precious metal strategy, releases a forecast, he's not trying to nail the exact price. He's signaling where JP Morgan sees risk and opportunity relative to current positioning. When Natasha Kaneva, JP Morgan's head of global commodity strategy, talks about supply constraints, she's telling you what her trading desk is watching, not what silver will definitely do. The forecast is the public-facing story. The factors they emphasize in that forecast are the real information. If Shearer's talking about industrial demand from solar and EVs, that tells you JP Morgan's commodity team thinks those sectors matter more than investor sentiment. If Kaneva's emphasizing geopolitical risk, that tells you JP Morgan's worried about supply disruptions. The actual price target? That's almost irrelevant. If you've made it this far, you're already thinking about this differently than 90% of people watching financial news. But don't stop now, because what I'm about to show you is how to reverse engineer institutional predictions to figure out what they're actually betting on versus what they're saying publicly. Here's the framework. Every institutional forecast contains 3 layers: the headline prediction, the stated assumptions, and the unstated positioning. The headline is what gets quoted in the media. $100 by March, $175 by year-end, $400 in a multi-year breakout. That's the attention-grabbing number. The stated assumptions are the factors they say justify that target. Supply deficits, industrial demand, monetary policy, whatever narrative fits the number. But the unstated positioning is where the truth lives. That's what their trading desks are actually doing while the public-facing analysts are publishing forecasts. Let me give you a concrete example. When Citigroup calls for $100 by March, their stated assumption is that current momentum holds for another 6 to 8 weeks. That sounds reasonable. But the unstated positioning reveals itself in their commodities trading activity. If Citi's trading desk is actively accumulating silver futures or recommending clients overweight precious metals, that tells you they think the real move is bigger than 100. The conservative public forecast protects them if they're early. The aggressive private positioning lets them profit if they're right. You get to see the forecast. You don't get to see the positioning. That asymmetry is intentional. Dominic Schneider, a commodity strategist at UBS, understands this game intimately. When he releases a forecast, he's balancing institutional credibility with client positioning. If UBS tells wealthy clients to allocate heavily into silver while publishing a modest public forecast, that's not hypocrisy. That's strategy. The public forecast manages expectations. The private recommendations capture upside. The difference between those two numbers is where UBS makes money. Now here's where this gets psychologically fascinating, because the real magic happens in your brain when you try to reconcile conflicting predictions. You read that Citigroup says 100. Then you read that Alan Hibbard says 175 or higher. Then you see an algorithm predicting 900. Your brain wants to split the difference and assume the truth is somewhere in the middle. That's called anchoring bias, and it's exactly what these divergent forecasts create. If the range is wide enough, any outcome feels predictable in hindsight. Silver hits 120? Well, that was between Citi and Hibbard, so someone was close. Silver hits 200? Hibbard was directionally right. Silver crashes to 60? Well, some of those conservative LBMA forecasts were in that range. No matter what happens, some prediction looks prescient. That's not forecasting skill. That's statistical inevitability when you flood the market with enough predictions. But here's the part that should genuinely concern you. The range of predictions isn't just wide, it's widening. 5 years ago, the spread between bullish and bearish silver forecasts was maybe 30 to 40%. Today, it's 10 times or more. That's not because silver became harder to forecast. It's because the underlying market structure changed in ways that traditional models can't capture. When China restricts silver exports, that's a supply shock that has no historical precedent in the datasets these models use. When the US designates silver a critical mineral, that's a policy shift that creates industrial demand dynamics completely outside normal market behavior. When 5 consecutive years of structural deficits meet surging solar panel production, that's a supply-demand imbalance that looks nothing like the previous 40 years of data. The models aren't broken, the market changed. And when the market changes faster than models can adapt, the range of predictions explodes. That range is information. It's telling you that nobody actually knows what happens next because we're in uncharted territory. Philip Newman, managing director at Metals Focus, has been analyzing precious metals supply chains for decades. He knows the production data better than almost anyone. And even he can't tell you with certainty what happens when you combine unprecedented industrial demand, export restrictions from the world's largest producer, and monetary conditions that make hard assets attractive. Those 3 factors have never occurred simultaneously in modern market history. There's no dataset. There's no model. There's just educated guessing based on incomplete information. Ole Hansen, head of commodity strategy at Saxo Bank, will tell you the same thing in different words. He can model supply, he can model demand, he can model investor sentiment, but he can't model the interaction between those 3 factors when all of them are moving in the same direction at the same time with policy changes accelerating the move. That's a chaotic system. Chaotic systems don't produce tight forecasts. They produce wide ranges and fat tail outcomes. Now let me tie this all together, because when you understand how institutional predictions actually work, you can start using them the way professionals do instead of the way retail investors think they're supposed to. The predictions aren't roadmaps, they're markers. When you see Citigroup calling for 100 by March, you're not supposed to believe silver will hit exactly 100 in exactly March. You're supposed to understand that Citigroup sees enough momentum to justify a near-term modest upside call. That's different information. When you see Alan Hibbard projecting 175 or higher based on structural factors, you're not supposed to plug 175 into your portfolio calculator. You're supposed to recognize that someone with deep precious metals expertise thinks the structural case outweighs short-term volatility. That's a different kind of information. When you see an algorithm projecting 900, you're not supposed to extrapolate that into a price target. You're supposed to understand that algorithmic models see enough volatility and momentum to generate extreme outlier scenarios. That's information about variance, not about destination. The professional move is to triangulate across all these signals and ask, what do the assumptions reveal? If everyone's talking about supply deficits, that tells you supply is the consensus risk factor. If half the forecasts mention China's export restrictions, that tells you policy risk is being priced in. If only a handful mention industrial demand, that tells you most analysts are still thinking about silver as a monetary metal, not an industrial commodity. Those gaps in emphasis are where the non-consensus opportunities live. Larry Leopard from Equity Management Associates has been vocal about silver's monetary role in a world of currency debasement. His framework emphasizes completely different factors than someone like Philip Newman, who's focused on physical supply chains. Neither is wrong. They're answering different questions. Leopard's asking, what happens to silver if confidence in fiat currencies continues eroding? Newman's asking, what happens to silver if industrial demand keeps accelerating while mine production stagnates? Both scenarios can be true simultaneously. Both drive price higher, but the path, volatility, and timeline look completely different depending on which force dominates. Philippe Gugels from BNP Paribas, Peter Grandich, a veteran precious metals investor, Nitesh Shah from WisdomTree, Peter Krauth, who wrote The Great Silver Bull, Joshua Glosson from Money Metals Exchange, Henry Yoshida from Rocket Dollar. Every single one of these people is looking at the same silver market and seeing something different because they're filtering it through different frameworks. The forecasts they publish reflect those frameworks. If you treat the forecast as the information, you're missing the point. The framework is the information. The forecast is just the output. Now we're in the home stretch, and I need to show you how all of this works together, because there's one final piece that changes everything. The most dramatic silver moves in history didn't happen because someone predicted them. They happened because a combination of factors aligned that nobody anticipated. 1980 wasn't in anyone's model. 2011 wasn't forecasted. 2025 caught everyone off guard. The pattern isn't that predictions fail. The pattern is that the biggest moves happen in the gaps between what models can see and what reality delivers. When you stack a supply deficit on top of export restrictions, on top of critical mineral designation, on top of industrial demand growth, on top of monetary uncertainty, you're not adding factors, you're multiplying them. And multiplicative systems don't behave like additive models predict. Here's what that means practically. If silver's supply deficit is 5% and industrial demand grows 5%, and investor demand increases 5%, traditional models add those together and forecast 15% price appreciation. But that's not how commodity markets work under constraint. When supply is tight, demand increases don't add linearly. They compound. A 5% supply deficit might cause a 10% price move. Add 5% industrial demand growth on top of that, and you might get another 20% price move, not another 5. Add investor demand on top of constrained physical supply and surging industrial use, and you could get a 50% move instead of another 5. The math isn't linear, it's exponential. And exponential moves look insane until they happen, and then they look inevitable in retrospect. Every major bank's forecast for 2026 is probably directionally correct. Silver's likely going higher. But the range of outcomes is so wide and the multiplicative factors so unprecedented that the specific number almost doesn't matter. What matters is understanding that we're in a structural shift, not a cyclical trade. Cyclical trades mean revert. Structural shifts break models. And when models break, the forecasts become noise and the fundamentals become everything. The Silver Institute, the industry trade association, tracks physical supply and demand with more granularity than almost anyone. Their data shows deficits extending as far as the eye can see. Not because of a temporary mine closure or a short-term demand spike. Because global industrial consumption is growing faster than mining production can respond. That's structural. You can't forecast away a structural imbalance with a model built on cyclical data. The model will keep predicting mean reversion until reality forces a repricing. And that repricing doesn't happen gradually. It happens in violent moves that look like chaos but are actually just the market adjusting to conditions the models refuse to see. So here's what you actually need to take away from every major bank's 2026 silver forecast. They're all guessing. Some are guessing conservatively to protect credibility. Some are guessing aggressively to capture attention. Some are letting algorithms generate numbers that sound precise but mean nothing. The range tells you nobody knows. The invalidated forecasts tell you the market's moving faster than institutions can adapt. And the factors they're emphasizing, supply deficits, export restrictions, industrial demand, critical mineral status, those are real. Those aren't predictions. Those are conditions. And conditions don't care what your model says. You're not supposed to pick the forecast you like best and build a portfolio around it. You're supposed to recognize that when the range of professional predictions spans from $93 to $900, you're looking at a market in transition. And markets in transition don't reward the people who trust predictions. They reward the people who understand the difference between a forecast and a structural shift. Your future self, the one who actually understands how institutional predictions work instead of being manipulated by them, is going to look back at this moment and recognize it for what it was. Not a time when everyone was predicting the future accurately. A time when the future refused to fit into anyone's models, and the people who understood that were the only ones positioned correctly. What else is happening in the precious metals market that nobody's explaining properly? What forecast or prediction have you seen that just doesn't add up? Drop it in the comments, because that's exactly what this channel is for. The banks gave you their predictions. Now you know what those predictions actually mean. Silver's 2026 price will be determined by factors we can't see yet, not by models extrapolating from data we already have. And that's not uncertainty, that's opportunity if you know how to read it.